Welcome today to Investing 101 Wealth Building Basics. This is our first February of 2025 Get Savvy, Grow Your Green Stuff webinar of the series for 2024-2025. And we are going to be talking all about investing. My name is Andrea Pellegrini, and I run the Student Money Management Center for the entire University of Illinois campus. And I've done that for about 15 years. And I'm joined today by my colleague Anne McKinley. Anne, do you want to talk about yourself, introduce yourself to our listeners today?
Sure. I'm an assistant director in the Division of Enforcement of the United States Securities and Exchange Commission, or the SEC. I have been here for a long time, and I am in the Chicago regional office, and we oversee a pretty much, you draw a circle around the Midwest, and that's the area that we oversee on behalf of the SEC.
Thank you so much for joining us, Anne, and providing your expertise in the SEC. So I'll let you talk about our disclaimer today.
Sure. So we do need to give a disclaimer. We are not providing any legal or investment advice today. We're just talking about general principles of sound investing and avoiding fraud. I do need to let you know that I am appearing in my official capacity as an assistant director in the SEC's Enforcement Division. However, my remarks are my own. They don't necessarily reflect the views of the commission, any of the individual commissioners, or anyone else on the SEC staff. The SEC is partnering and working with Get Savvy for these investment-focused seminars, but is not responsible for administering the program or any of the other webinars.
Thank you so much, Anne. I get the pleasure of working with lots of different people like Anne to coordinate all these webinars, and we are very blessed for everyone that contributes to these webinars. But I also want to know a little bit about who's joining us today. So we're going to launch a demographics poll. You do not have to answer, but it does give us a little bit of information on who's joining us, how to cater some of our examples for illustrative purposes, as well as helping us to identify where there might be specific needs in the future that we should address when we're doing some of these webinars. It is anonymous, so that hopefully will help you make your decision on whether or not to participate. Thank you for those of you that did choose to participate. It looks like we have a very broad age range of participants. Like I said, we had over 400 people register for today's event. From all kinds of age ranges. We have both students and full-time employees, as well as some unemployed and part-time employees. We also have a pretty diverse gender distribution, as well as race and ethnicity. So thank you for joining and for providing that information. And hopefully we will provide some increased helpful information and illustrations today with that information. I'm going to end the poll, and I am going to get us rolling with the learning objectives. All right, so obviously we're going to cover the basics of wealth building today, and some of our objectives include talking about how to create a financial plan to get started with investing. We're going to define a few common investing terms and concepts. It won't be all of them. There's a lot to learn when it comes to investing and economic principles in general, but we'll get you started with a few. We're also going to identify how to select investment professionals, maybe a few things to ask them, and what kinds of fees to watch for when it comes to investment professionals and products. We're also going to illustrate a couple types of investing tools that you might run into, or strategies. And we're going to summarize some other ways for you to continue learning about investing. There's a lot of misinformation about that, the types of investing that you can do or what's best. And so we want to give you unbiased information so you can make informed decisions for your own situation. So when it comes to creating a financial plan, some people are planners, some people are not planners, and that's okay. We're going to give you some uh, things to consider when you're thinking about setting up your plan to eventually start investing. Oh, there is something going on with my slides that I didn't notice. Well, it's supposed to be saving on the left and investing on the right, but Often people use these words of saving and investing interchangeably. Ultimately, the financial products and services that cater to savings and investing differ on how risky they are and how much potential for returns there are with those products. So, for example, with savings, some types of savings tools include money in savings accounts, obviously, money in money market amounts and certificate of deposits at banks and credit unions. These types of financial products have almost no risk of losing money, but returns tend to be very low. However, they are usually insured from loss if your savings accounts are at an FDIC or NCUA insured institution. Investments or investing products in general, some examples of that include stocks, bonds, mutual funds, exchange traded funds or ETFs, real estate, commodities, those different kinds of asset classes that we'll talk about later. The risk of losing money with these types of investing tools can range from very low to high. So it's important to remember that the possible returns are higher than with savings focused products, but the value can be volatile and they are not insured, like with some of the other examples I talked about with savings. So, another thing to consider is that you can't just put all your money into savings or stick it under a mattress because the money that you have today won't have the same purchasing power for what you need later on. For example, prices for goods and services tend to go up over time, and this particular concept is called inflation. We actually talked about this in a webinar a couple years ago, just about inflation and its impact on cost of goods and how it varies and how it's measured in lots of different ways. Um, One thing to consider when you're thinking about investing, for example, you could have gotten the original iPhone around $600 in 2007. That was 15 years ago. But today's top model will cost you almost double that. So that's the result of inflation. Investing is your best way to cope with the impacts of inflation, which is why it's such an important aspect of financial planning. All right, I have some more problems with my slides today. All right, I'm going to take a moment to see why this is. It's a lot of my slides. Okay. It looks better now. Apparently, I just needed to stop and start again. All right. So, in order to transition from a survival mindset to a wealth mindset, you'll need to frame your trade-offs to accomplish kind of your wealth building goals. For example, you need hydration, but a venti pumpkin spice latte, maybe a want. Food is obviously a need, but a DoorDash delivery for Chinese, maybe more of a want. Shelter is definitely a need, but a luxury apartment with no roommates is a choice. It's often a want. So, I'm a big proponent of values-based financial decision making. So, if one of these examples is a priority for you, just recognize what the trade-offs are of that choice when you're thinking about starting your investing journey. So, to make this more illustrative, in shifting our mindset, it's important that we leave room for saving and investing, right? That's the whole idea of assessing what our real priorities are and when looking at needs and wants. For example, instead of getting a $50,000 sports car that costs up to $1,000 a month to maintain, maybe you opt for a $25,000 car with around a $370 monthly payment, and that leaves room for contributing $100 a month to emergency savings and $300 a month to retirement and even some spending money left over. So think about what your priorities are when you're making big or small financial decisions so it gives you some room to focus on wealth building. All right, so investing is typically a part of many people's financial plan. So beyond setting your own financial goals, part of creating a financial plan requires awareness of your own financial situation. That includes debt and assets that you might have. It also requires you to establish an emergency savings, pay down high interest debt, and then researching investment options for your goals and determining your risk and limits, your risk tolerance and limits at least. You definitely want to have these steps completed before you start investing or even purchasing a home. Big purchases would be another thing to consider with this approach. So, what's considered high interest when you're thinking about paying down high interest debt, which is a big tenet of the things you want to do before you start investing? Um, what's considered high interest can vary from person to person or even among professionals. Today, I looked it up literally today on February 6th, 2025. The average 30-year mortgage rate is 6.8%. So if the interest that you're paying on a debt is above 7%, you'll probably want to prioritize paying that debt down before you get started with investing. The big thing with paying down debt is paying more than the minimum. So you might want to use the debt avalanche or the debt snowball method to expedite paying off your debt. And you'll pay the least amount of interest using the debt avalanche method since you prioritize paying more than the minimum on your highest interest debt. But some people maintain motivation a little bit better with the debt snowball method since you pay off the lowest balance debts first. So your list of debts gets smaller faster. If you have federal student loans, you may consider a direct consolidation loan to simplify your payments, but that's not always the best option for everyone. So do your research or join us for our webinar in March on student loan management if you have student loans. Utah State University Extension created a debt repayment tool to help people make debt payoff plans called powerpay.org. And our colleagues dropped that in the chat for us for you to check out. All right, so I think a really important consideration for setting an emergency savings goal is that the small amounts that you contribute to your savings really do add up. So let's go through a little bit of an example. Typically, professionals say that you should have 3 months of essential expenses that are readily available to you. But if this seems too challenging, just start with saving up to $400 since a whole lot of Americans can't cover a $400 expense without borrowing or selling something that they own. So remember these tips when it comes to setting and accomplishing your savings goal. You want to start small, save securely, like with a bank account, maybe across town, so it's harder to get access to. Make sure it's FDIC or NCUA insured, and you want to keep going. So once you reach that $400 or that $1,000, try to get up to 3 months of expenses, 6 months of expenses, 9 months of expenses. And you also want to take advantage of one-time opportunities like tax refunds or gift money to help beef up your emergency fund before you get into the investing habit. All right, so we talked about compound interest just a little bit ago, but another thing to consider with compound interest and time is how much time do you need or how long do you have to invest to reach a specific goal. So it will really depend, it will really determine what you should invest in. So for long-term goals, inflation is obviously your greatest risk. We already talked about that. So investing can and taking advantage of compound interest can really help you overcome that inflation risk. For short-term goals, those that maybe you're hoping to achieve within the next 5 years or even less, volatility may be the biggest risk factor or have the greatest impact on your ability to reach those goals. So you want to choose investments whose values won't fluctuate quite as much. The earlier that you start investing, the more time that you have to take advantage of compound interest. So obviously we have this example up here. So if you are 22 and you decide that you're going to contribute $2,000 annually for 9 years until you hit 30, and you're not going to contribute any more money, you've saved a total of $18,000, but you're taking advantage of compound interest over time. And I believe we have 9% is the assumption on this particular example. At the end of at 65, you're going to have over $570,000. However, if you wait until you're 31 and you're still going to contribute $2,000 annually, but you do that for 35 years, you've contributed $70,000, but you have less than if you had started when you were 22 and only saved for 9 years. So that's just to illustrate the power of compound interest over time. So another example that I want to point out, let's say you decided that you want to save $500,000 by the time you're 65. Leveraging compound interest and investments that provide an average of a return of about 7%, you could save as little as $127 a month if you were starting at age 18. Or if you start later, you may need to save as much as over $3,000 a month to reach your goal if you started at 55 and you're trying to reach that $500,000 by the age of 65. So again, time is really important in long-term investing strategy, and it gives you a lot more leverage for your money. All right, so you may be wondering at this point, we've talked about time and goal setting and the importance of emergency funds and paying down debt, but how do investments actually work? So ultimately, either someone pays you to use your money, like in the form of interest or dividends, or you buy something that could increase in value, like when you buy a stock in a company or real estate. You hope that when you sell those items at a later date, they have gone up in value. So that is the most basic kind of function of how investments work. And I'm going to hand it over to Anne to get a little more complicated and in the weeds with some of the common terms.
Okay, so investing has a lot of risks and a lot of rewards. And what we're going to talk about, we'll go over the common terms, but also just some of the things that you will encounter when you start investing. And then you can decide how much you want to invest now and in the future based on what we're discussing here. So one question that a lot of people tend to have is, what is the difference between the stock market and a stock exchange? And a lot of people do use the terms interchangeably, but they are not the same thing. Typically, a stock exchange is a specific platform or marketplace where certain investments are traded. The stock market is kind of an overall term encompassing all of the different exchanges that are out there. Another question that people have had is, what's a bear market? What's a bull market? And you'll hear people on the news talking about the different types of markets. If you're following a particular security, sometimes you'll hear an analyst talking about that they are bullish or bearish on that particular stock. So what is it? Bear means prolonged decline in stock prices. I think it's been defined as 20% drops or more, but really anything where we have declining prices over time would be considered a bear market. And bear markets can last from just a few weeks to years. Bull market refers to a prolonged rise in prices. And again, it could be up to 20%, but it's usually after there's been a decline, then when stocks tend to trend up. And so if someone is talking about a particular security and saying that they're bullish on the security, they think the price of that security is going to go up. If they're bearish, they think the price is probably going to go down. And the stock market experiences periods often where we'll have a trend up and then a trend down. But we're not talking about a one-day spike. That doesn't mean, yes, we've turned into a bull market or a one-day huge drop. That doesn't mean that, the stock market has turned bear. I think that the biggest bull market we have is probably following World War II. And then after the housing market crashed in 2008, we had a pretty significant bull market. So asset classes, what are they? We're going to talk about particular asset allocation a little later, but we just want to make sure that everyone is aware of what the different types of asset classes are. And these are the places where you can put your money. Equities refers to stocks. Can refer to mutual funds or exchange traded funds. Fixed income, that's going to be bonds, anything where you're loaning money out generally and getting money back. Cash, I think everybody probably knows what cash is. Same thing with real estate, commodities and futures. Tend to be when people are trading in options. And then we have all sorts of alternative investments. And we're probably not going to go into a whole lot of detail on those today because we want to go over the basic investments. All right, so what is a stock? A stock is basically owning a piece of ownership of a company. And it gives you a share in the assets or earnings of that company. A bond is different. There, you're actually loaning money out to the company. So any issuer, if it's a corporate bond, would be borrowing money from the bondholder, and then they promise to pay you back what you put in, your principal, and some interest. And that's why someone would invest in it. Mutual funds and exchange traded funds, sometimes people use the terms interchangeably, but they are slightly different. Both are ways that your money is pooled together with other investors' money. A mutual fund takes the money from many investors and buys usually a diversified portfolio, but sometimes they could be specific to a particular sector of stocks, bonds, other types of investments, and then someone actively manages it in exchange for a fee. An exchange traded fund is another type of fund similar to a mutual fund, except usually it's tied to a particular exchange or sector, and it trades like a stock more than a mutual fund. Often ETFs are more passively managed, so they essentially invest in the entirety of a particular industry or something like the S&P 500 and then just leave it. All right, so let's get started with some investing. Where do you go? One popular place to get your money to work is through an employer-sponsored retirement plan. This would be a 401k, or if you work for the government, the thrift savings plan. And that's a great way to invest. You don't have to go out and find another professional. You usually can do it through your workplace. You can even have money taken straight out of your paycheck and invest that way. I think, Andrea, you were going to talk a little bit about Illinois Secure Choice, which is a little particular to Illinois.
Yes. So Illinois Secure Choice is an option for anyone that has employment within the state of Illinois and doesn't have access to like I want to say IRA, not an IRA, a 401k or 403b through their employer, They can choose to participate in Illinois Secure Choice. It's actually a law for even small businesses to set this up. It's managed at the state level, but it gives people more access to retirement options, retirement savings options. So one of the things that Anne mentioned, if you're a government employee, there's the thrift savings. I'm sure a lot of the full-time employees on this call are employees of the University of Illinois, and we pay into SERS, for example. It's similar in a lot of ways to that. So I mentioned 401k and 403b. Those are different types of retirement funds. We've talked about the retirement crisis and access to retirement issues on our podcast, which I believe is in our chat. So you can learn more about Illinois Secure Choice, the retirement crisis, and kind of the differences between retirement options based on your employment. So hopefully that gives a little more context. Retirement in general is like alphabet soup when you're trying to start planning for it and you haven't done it before. So just take a deep breath if you're overwhelmed. Hopefully that provides the context we needed for me on this particular slide. Is that good with you?
That's perfect. So let's get back to then talking about some of the other places that you can invest your money. So you can go to an investment and management firm. This would be an investment advisor. And in general, you can get to pretty much any type of investment through them. They will take a cut, and we'll talk about this a little bit more later, but they will take a cut of the money that you have invested with them called an asset under management fee. So it would be a fee-based type of account, but they can pretty much help you and give you advice on anything. Or if you don't need that much advice, you could also go to a broker-dealer. Broker-dealer could be any of the big names you know, could also be a discount broker. A lot of them have both online and in-person facilities, and then you can invest in stocks, bonds, anything that you'd like through them. Same thing with an investment app and a robo-advisor. They're just other ways of getting access to the markets and making investment decisions. One thing, and I'll probably harp on this a little bit more as we go on, please watch out for fees, because nobody does anything for free. So you want to be asking and looking at how much you're being charged. So let's delve a little bit deeper into what you would need from a financial firm, and why not just to do it yourself, which you can. So you can use financial services to help you make trades. If it's an investment advisor, they'll give you advice on where they think you should put your money. Sometimes they'll help you put together a plan for how to invest, how long to invest, what types of different asset classes to invest in. And then anytime there's something that happens in your life, you could talk to them and they could help you adjust your priorities. Say you're saving for a home and you want to make sure that your money is set to come out at a certain point in time. That's something that an investment professional could help you with. You can also do your own research, and we'll talk a little bit more later, but I'll give a plug right now. The SEC has an investor-focused website that provides not investing advice, but all of the tools to arm yourself, where you can do research, where you can figure out what a particular term means and decide if that's the type of investment for you. It's called investor.gov, so investor.gov. And it's a great non-biased informational source that the SEC has set up to educate investors and to help them educate themselves. If you look at each of the financial firm information on the slide, and it looks like the slide is messed up again.
Yeah.
That particular, I can read that if that would help.
That would be very helpful. Thank you.
The slide with the handshake icon portion says ongoing investment management, the financial professional gets your permission before any purchase or sale. And that is with any type of financial professional that is like a broker. They need your permission before they make any sales or purchases. If you decide to go with an investment advisor, they sometimes will ask you to have management over your fund. You can give them that if you want to, but just be aware, you'll find out after the fact that they've purchased or sold securities. Okay. So as I said, we're going to talk about costs. Ask questions. There is no such thing as a free investment. And if someone tells you that it is free, be very, very careful and ask a lot of questions because they're getting paid somehow. If you are trading through a broker-dealer will charge you a commission on every single transaction you make. Now, many of these commissions, depending on the particular broker, may not be that large, but they're charging it each time. If you go with an investment advisor, then they're going to charge you a fee based on the services that you've asked them to provide for you. Oftentimes, the fee that they'll charge is a percentage of the total assets that you have in the account that they are managing on your behalf. And these types of fees can vary wildly. There are also other fees. You could be charged a fee for research. You could be charged a fee for making a wire transfer. So just be aware of what the fees and costs are upfront so that you're not surprised when, you thought you were investing $20,000. Instead, it looks like you've only invested $19,000. Okay, here's investor.gov. So it's really important to double check any investment firm or any professional. The gobbledygook icon says employment history. So you can, if you go to investor.gov, right on the front page, it says check out your investment professional. And this will give you access to all sorts of information. Look at it because anyone selling you an investment has to be licensed. If they don't have a license, then they should not be selling you any type of investment and you should walk away. If you look them up and you see from their employment history that they have changed firms from year to year to year to year, that could be a red flag because why are they switching every year? You also see other disclosures about if they have any disciplinary history. If they pop up and it says that they have been barred, that's a huge red flag. Find somebody else if you can. But the first step, you need to be the one protecting your hard-earned money from investment scams. And this is the first step you can take.
So, Anne, I'm going to restart the PowerPoint because I think the gobbledygook is a problem with the PowerPoint running. So I'm going to restart PowerPoint. That's the value of running this show ourselves. We can try to troubleshoot in real time. And I hope everyone is understanding of that that's attending today. So we're going to restart and with just the PowerPoint. And for anyone that might be watching this on YouTube, once we get it all figured out, I'm going to edit the visuals so you don't see gobbledygooked. So that's one of the benefits that we also have with recording these. All right, so we were on this one.
I think we can go 2 forward now.
All right, there we go.
Okay, so as I was saying, just double check. Don't just trust, verify that what someone is telling you is actually true. And above all things, make sure that they are actually licensed. We've seen a lot of fraudulent schemes with people representing that they have all the requisite securities licenses. And then if you look them up, they've never been licensed before. Okay. Another thing you can do, research the investments themselves. So for the individuals, go to investor.gov and there are links there to BrokerCheck to check out any broker. There's also an investment advisor database called IAPD that you can also link to from investor.gov and check them out. If you want to research the individual investments, there's also a link to the SEC's, it's really a repository of all the filings that a company has ever made, called EDGAR. And you can get to it through investor.gov. You can also get to it from the SEC's homepage. That's public, it's sec.gov. And you can pull up 10K, which is the annual report that all public companies are required to file. You can look and see if they have any 8Ks, and 8K is like a news report that goes in between the required filings about something important happening with the company. If you want to see if the CEO, the CFO, or any of the other officers or important shareholders are selling their securities, you can look those up on forms 3, 4, and 5. And so there's a wealth of information. Sometimes it can be a little overwhelming because there's a lot there, but looking at a 10K, the annual report generally will help you see what's generally going on in a company. And then if you look at any 8Ks, you can see if there's news that's coming out in between that's important to know. Emma is another really good research tool. It is the Municipal Securities Rulemaking Board's website, and it includes all sorts of information and documents for any types of municipal securities, like municipal bonds. These would be, if a school district sells a bond, or a state sells a bond, or a city sells a bond to investors. You can get more information about the quality of the bond, the timing, all of that through Emma. And same thing with 529 plans, which are college savings plan investments. You can use Emma to look them up and see, which ones might be beneficial for you, and what the tax information on each of them is. So retirement investing, Andrea already touched on this a little bit, but one of the things that it is important to think about when you start investing is making sure that you're going to have enough money in retirement. And so there are a couple different ways that you can do this. If you want to invest in an individual retirement account or an IRA, there are a couple of different kinds you can set it up yourself, and there are significant tax advantages depending on the type that you make. You can either get taxed on the front end, or you can get taxed after you pull your money out, when maybe your income might be lower. Employer-sponsored retirement plans are a really easy way for anyone to get started investing. Most employers will have a variety of investments that you can choose from. As we talked about earlier, this is a 401k, 403b, or in government, the TSP, Thrift Savings Plan. And the really nice thing about a lot of the employer-sponsored retirement plans is that the employers may match a portion of the money that you are putting in, which means basically every time you put in money up to a certain amount, you should put in as much as you can up to that threshold, because they're going to match it and put that same amount in for you. So you're getting double. Let's talk a little bit more about IRAs. The requirements for an IRA are that you must have earned income, but you can start contributing at any age. So if you have even a teenager who's earning money from summer jobs, they would be eligible to start their own individual retirement account. The contribution limits do vary by year and age, and that changes over time. So pay attention to the IRS. They publish what the limits are every year. Also changes by age. So usually it's around 50. You can start contributing more than you could under 50. And they call that a catch-up contribution. And there are a bunch of different types of IRAs. This is something you can get some information on investor.gov that talks about the different kinds, and it really depends on your individual circumstances, which kind would make the most sense for you.
We like to call those IRAs, those different types of IRAs, as well as all the different type of employer sponsors retirement plans, alphabet soup, because it's always like letters or numbers, and they can be a little bit complicating to know what the difference is. So the tool, the investor.gov tool that we've been talking about and that Anne's been doing a really good job of highlighting, can be a valuable resource for learning the differences of those, because not all retirement options are created equal. All right. So one thing with employer sponsored retirement plans that I want to emphasize is that vesting is something that you'll want to pay attention to when taking advantage of those employer sponsored retirement plans. This is where your employer offers to match your retirement contributions up to a certain amount, and kind of talked about that. So, or at least started the conversation. So in order to keep those contributions from your employer, you'll need to meet the criteria that the employer defines for being vested. So to just provide an example of what that means long term, so we have an example here of what it means to maximize your employer match. Let's say that your employer offers to match up to 50% of your contributions, that's up to 6% of your salary towards a 401k. You have to work there at least 5 years to be vested so that you can keep the contributions if you leave. So if you make $60,000 a year and you contribute 3% of your salary, that would mean $1,800 that you contribute. And then your employer will contribute $900, because that's 50% of what you have contributed, for a total annual contribution of $2,700. So assuming a 7% return over 30 years, you'd have over $256,000 roughly. However, if you max out your contribution at 6% of your salary, that would be $3,600 that you contribute, plus $1,800 that your employer contributes, for a total of $5,400 in annual contributions. Again, assuming a 7% return, you'd have over $511,000 in your retirement account after 30 years. So you definitely don't want to throw away that extra $1,800 benefit from your employer, and that additional contribution could nearly double your retirement funds growth over a 30-year period. So this is just to kind of show you don't want to throw away free money. So that's why it's important to take advantage of maximizing your employer match and to know what it means to be vested. All right, so I'm going to hand it back over to Anne to talk about mutual funds and ETFs.
We touched very briefly on mutual funds and ETFs earlier, but they're essentially a easy investment for people who maybe don't want to spend the time researching individual stocks, want someone else to manage their portfolio for them. So the similarities are basically someone pools money of many different investments together, and they will buy a variety of stocks, bonds, or other securities in some combination. And then you will make money based on how much that whole basket of investments goes up, or lose money as it goes down. The benefits: auto diversification. Instead of you having to pick out different securities to make sure that you have kind of a broad cross-section of investments, so that if one goes up and another goes down, you kind of break even, or even maybe go ahead a little bit. It's automatic diversification. They're managed by professional money managers. So you don't have to do the work. They'll do the work for you. And they're generally very affordable. They usually don't have very high minimum investments. So even if you don't have a huge amount of money to invest, you can get an investment started. The risks of them are typically the same as the underlying securities, but remember, generally they're fairly diversified. So they're looking at trying to cover you from any ups and downs in particular segments of the market. So what are the differences between them? First of all, how they're traded. ETFs, or exchange traded funds, are traded on the exchange. They are, you can go in and out on the same day. The price fluctuates throughout the day. Mutual funds, on the other hand, the price, it only happens at the end of the day. When do they disclose what it is that they're investing in is another difference. Exchange traded funds disclose daily what it is that they're invested in. And usually they will be every company in a particular sector, the vast majority of them, or something very broad like the S&P 500 or the mid-cap index. Mutual funds, on the other hand, are required to disclose what their holdings are only every quarter. So they could be buying and selling a bunch of different things and you may not know about it. So depends a little bit on how much you want to know on a daily basis what you're investing in. And then you also have to look at the tax treatment for them. I'm not a tax expert and I'm not going to give any tax advice, but go on investor.gov. It will give you some things for you to ask questions about which type of investment is best for you. So index funds oftentimes are ETFs, but the goal of something that focuses on a particular index is to basically match the performance of a benchmark. So the S&P 500, the largest 500 companies generally in the United States markets, what we're trying to do with an index fund tied to the S&P 500 is just basically lockstep match the performance. These are much more passively managed. So essentially they set it and it just follows the S&P 500 instead of someone looking at it and actively saying, ooh, I think that this particular segment of the industry is going to go down. So we're going to sell some of the securities in this area and buy more securities in this area. Instead, it's just set. Provide automatic diversification across a wide range of different sectors and companies. And usually the fees for an index fund, because it's so passively managed, are generally lower than a fund that would be actively managed. So again, pay attention to the fees because that can make a huge difference on how much you're actually investing and how much you can actually gain from it. So we're coming on one of my favorite topics, diversification. Diversification is when your investments are spread out across different companies, different sectors, or even completely different asset classes. And the nice thing about diversification is it lowers your risk because even if one investment, one company, one industry, one sector is losing value, your other investments could limit your losses or even go up and allow your overall investment to grow. So diversification is something that is really important for everybody because you don't want to put all of your eggs in just one basket. Okay, so here is a perfect example of diversification. This graphic shows the performance of the stocks in the S&P 500 index over a single day. So if you look, there are a lot of names and symbols that I'm sure everybody probably recognizes. If you had everything invested in, and I'm just going to pick on Microsoft in the upper left corner, you'd be down for the day. Same thing if you're invested in Amazon or Google or NVIDIA or Adobe or Apple, all of those were down. If you were invested just in technology, if you look at most of the symbols in the technology sector are down, so you'd be down for the day. On the other hand, if you were investing in the S&P, you can see there's an awful lot of green in some of the other sectors. And so you might even break even or even post a gain on the particular day. That's really just the theory of diversification. The more diversified that you are, the more protected you are for ups and downs.
I think, Anne, because you've mentioned S&P a couple times, maybe we should explain what that the S&P is a specific group of collection of investments. Can you explain S&P for any of our more novice attendees?
Sure. So first of all, S&P stands for Standard and Poor's. It's a credit rating agency and just a general like research agency. And so the S&P 500, which I think I brought up probably 10 times at this point, is really a bucket of the biggest and most profitable companies in that are listed on the United States stock exchanges. And it changes over time. A lot of the names stay the same year to year, but sometimes if something is doing really well, it could come on to the S&P 500. But it's really just tracking the stock performance of the 500 biggest companies on the US markets.
Thank you, Anne. I think that helps a lot. It's if you look up index funds, there's lots of different flavors or brands of these collections of different types of stocks on the US stock exchange or even global exchanges. So if you're interested in that, that's something to research. So speaking of research, there's lots of different ways to continue learning about investing. You're not going to go to this 1 hour webinar and learn everything there is. So investor.gov, which we talked about a lot, provides tips for avoiding fraud. There's a compound interest calculator to help you with understanding maybe how much you need to invest to reach a certain goal in the future or based on the average interest rate that you're getting with a particular investment product. There's also a lot of unbiased content for investor research, which is helpful. And there's other kinds of publications that you could look at. Obviously, we've done other webinars that you might want to learn more about investing through. So we just did Building, Protecting, and Leaving Your Nest Egg, which is more about kind of how to set up your assets in case something happens to you, or how to navigate kind of a transition, a life transition involving a loved one if you're in that situation. We did that just last November, I believe. And so that's on our YouTube. Investing 101 is today, right? We're also going to do Investing 102 on the 20th. That's in 2 weeks from today on risks and rewards. So we'll get a little bit more advanced than today's did. We've also talked about all kinds of investing related topics on our Making Sense of Money podcast with the Illinois Department of Financial and Professional Regulation, the Division of Banking. We partner with them on that particular podcast, and there's lots of episodes on investing and investing adjacent concepts that you can listen to. And then if you really want to like get started with the technical aspect of investing, you might try simulation. So there's a stock market game, and MarketWatch has a virtual stock exchange that you can kind of track things and kind of look at things from a simulation perspective before you actually jump in and start investing. So, in summary, it's really important for you to have a plan before you start investing. You want to pay down any high interest debt that you have and have an emergency fund that's more liquid. You want to inventory some of the tools that you have access to for longer term investing. We talked about employer sponsored retirement programs or plans, as well as within the state of Illinois, Illinois Secure Choice and individual retirement accounts. All of those things are different tools that you can use for longer term investing, like for retirement. You also want to compare costs. We talked a lot about fees today, and that's because fees can really eat up your longer term gains when it comes to investing, especially for a longer term, but even short term. So really pay attention and compare costs as much as you can. And diversification is extremely important to limit the risks of investing. So, thinking about diversifying in different tools, like using the S&P 500 index as a metric for how you want to diversify, may be very helpful. So, again, our next webinar is on February 20th on investing risks and rewards. That's also a Thursday. We have a post-webinar survey we're going to put in the chat. So hopefully you can fill that out and let us know how we did today and what you want to learn more about. And then if you want to watch previous webinars on YouTube, you can go to go.uillinois.edu/getsavvy or search for IL Student Money to see the Student Money Management Center's YouTube page. All right, so we have lots of collaborators that help on this, obviously, and I can't thank them enough. But I know that there were a couple of questions in the chat, and hopefully we can answer them. There's some of them that might be a little bit outside of what we can do, but there was one question that was recent that I think we can answer quickly. What is the difference between a 403B and a 401k? So, Anne, do you want me to answer this, or are you comfortable answering this one?
My understanding, and please jump in, Andrea, but my understanding is 403B, it tends to be more limited to government or not-for-profit, whereas 401k tends to be more corporate.
Correct. That's exactly what I would have said. So if you're a University of Illinois employee, we have access to a 403B option in addition to SERS. So that's something to consider if you're looking at other ways to contribute to your retirement savings goals. Maybe you have a really aggressive goal so you can retire early. There's obviously limits to what can be done through SERS, and so 403B might be a good option. Obviously, IRAs are another good option, but those are outside of the realm of employer-sponsored plans. All right. Are IRAs accessible to international aliens? So that's a loaded question, but Anne, if you wanted to try to answer it.
Yeah, that is really much more of an IRS question. So that kind of goes outside my realm of expertise.
So a couple weeks ago, we did a taxes for international students webinar. I don't think we specifically talked about IRAs, but there are some limitations based on your status as a foreign national or there's a lot of different statuses when it comes to tax, and that's different than immigration, and that's different than what you would pay with tuition. And so that's why that is a more complicated question than yes or no answer comes for. It also depends on whether or not you have access through an employer, since some international aliens can be employed, right? For example, if you are a graduate student at any of the University of Illinois system universities, you have access as a graduate student employee, like a graduate assistant, a teaching assistant, or research assistant, to contribute to a retirement plan. However, that access could be different depending on what type of graduate student employee you are. So the easy answer is it's complicated and we aren't sure. All right. I know that some of our colleagues that were on this as co-hosts were getting direct messages too. Steve, did you get any messages that you think that we can address?
I did not see anything directly to me.
Okay. We have an interesting question that seems more of an economist type question, but I'm going to put it out there in the ether in case Anne has some thoughts. So, if more and more people continue to invest in the stock market, how does that impact the market in the long term?
The last statistics that I saw, when it was something like 60+% of Americans have investments in the stock market. So it's a huge percent of I think our nation's wealth. One thing that, I think you have to be aware of, there are limitations on how many shares companies may have. Many of the large companies have shares that are trading all the time. But one thing to check out, and you can see this through Edgar, is when companies, sometimes companies will go private and they'll buy up their shares, or sometimes they will issue new shares. Every time a company issues new shares, it decreases the amount that each one individually is worth. Sometimes that's just a fraction, sometimes that's bigger. Sometimes if a company gets to a really high price, and this is probably getting a little bit more into investing 102, but the stock may split. And then at that point, each of the people who already own shares, yes, the cost, the actual amount per share will go down by half, but instead of just having one share, you'll have two. So
I
you
actually
double your
had
holdings, and then it might go up some more from there. But it also, gives more people potentially the chance to invest.
I've heard of several people having that happen with the stock options provided through their employer over a long period of time. They ended up with double what they had originally started with. So that's a great example. So someone did ask if 403Bs also has an employer contribution. So I want to emphasize that not all employers offer retirement benefits at all, and not all employers offer a contribution. So for anyone within the University of Illinois system, the 403B option that I talked about does not have an employer contribution. Only the SERS that we have access to has an employer contribution. And there's, when it comes to looking at the broader scope of employer benefits and options, not every industry provides the same access to employer-sponsored retirement plans. So, for example, in like public domain areas, let's say by industry. So let's say in the agriculture industry, employers may only 50% of employers may offer access to employer sponsored plans. If you look at the dining industry or the recreation industry, it's even less. So industries vary on how much access they provide to employer-sponsored retirement plans. It's something that we talk about more in depth in the podcast that I talked about earlier. So just because you have learned about employer-sponsored plans doesn't mean that you are owed that when you go to start employment somewhere. So it's important when you're looking at different options. Let's say you were offered two jobs, to look at the whole package, not just what the salary is. Do they even offer employer sponsored retirement? What is the contribution if they do offer it? What other benefits are associated with that position so that you can make a more informed decision on whether or not a particular employment opportunity helps you accomplish your longer term career and retirement goals, in addition to whatever lifestyle that you want to maintain. That got real complicated and deep real fast, but hopefully it is really helpful. All right. Were there any other questions that popped in? I know there was one about this information being provided via email. So we always record these webinars and we make them available once we've edited them and captioned them for accessibility to anyone that registered for the webinar. We also try to create a little course that you can go through and learn more about these topics with a quiz. So we're going to try to package this all up really nice, hopefully sooner rather than later. It's taken us a little bit longer in some cases to package those up, and we'll send it to anyone that registered. We're also going to post it on our YouTube channel and on our website. And I'm talking about Student Money Management Center. So hopefully that helps everyone. Anne, were there any other insights or things that you wanted to note before we log off for today?
I think we covered everything we planned, and thank you everybody for listening.
All right. Thank you again. I will wrap it up and have a wonderful afternoon.